Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He was the Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. Welcome back to the show, Victor.
Well, thank you, Jimmy.
Victor, the S&P 500 and the NASDAQ are trading at all-time highs. Everybody knows just a handful of mega-cap tech stocks are dragging the whole thing up. But what about all those other stocks that are lagging behind?
Well, there is a huge divergence in the market, certainly. I think we've got the NASDAQ, for instance, which is the hottest index of pretty much all of the major indices. It's up 65% overall, but that handful of what we call FANG stocks that you were referencing is up more than double that. So, any which way you want to look at it, we've got a lot of concentration. A lot of the market cap, I should say, is concentrated in a very few stocks, and those stocks are pulling the market higher. Now, there's more to it than that, obviously. I think we're in sort of a manic phase. Now, let me preface this, maybe go back a little bit. When we had the stock market begin the year, going into February, we were at all-time highs, and then we had the panic, let's call it, around the virus. Markets sold off very hard down into the March lows. And then massive stimulus announced by both the central banks and the governments, and the market starts to rally. And as the rally was happening, to be fair, I'm just trying to be even-handed here, I thought that we were having a bear market rally. Things were really in tough shape, and we've had a bounce here on all the stimulus, but this probably isn't going to last and the markets will roll over. Well, like I'll say so many times, you just never know what's going to happen. I was wrong. I had a view that the market would rally a bit, but not get back to the February highs, and would probably roll over as the reality that we were seeing in the economy began to be a drag on the market. That hasn't happened. So here we are. I'm calling it a bit of a manic phase. I see that today the CNN Fear and Greed Index has finally printed an extreme greed number. That's just over 75 on an index of 1 to 100. And that's the first time in months we've seen extreme greed. I think there's a career risk here for money managers. I mean, if you're a professional money manager, whether you're running a hedge fund or, just sort of a stockbroker, and anything in between, if you're managing other people's money and you're not, in these hot stocks or the markets, the ones that are going up, you're running a risk of getting fired. So there's FOMO, that fear of missing out, not only at the individual level, but at the professional level, where people who are handling other people's money need to be there. There's also this TINA thing. There is no alternative, and really, in a world of zero return on fixed income, effectively, people are going to take risk. Now, this is where it gets interesting. Anytime you go out and take risk and you get rewarded, you go, gee, that was pretty good. Maybe I'll take a little more risk. So we have that too. Where we're at today, the NASDAQ index here, the difference between where the NASDAQ is at, the index, and its 200-day moving average, which is obviously going to be well below the current level here because it's can't catch up. This is the widest spread, or the NASDAQ itself is further away from its 200-day moving average than ever before, ever. Our mutual good friend Ross Clark put out a report here today saying there's upside exhaustion alerts on the NASDAQ. What I think here is that we're in kind of a little bit of a silly summer season. I think the market, the stock market is being aggressively overbid. And I think that if for some reason the market was to take a tumble here, we could have a good sharp fall. Now, I'm a little bit talking my book. I have been poking at the stock market from time to time with short positions, generally getting stopped out with some small losses. And right at the moment, I am short of the Russell, and this is the weakest of all of the indices. This is the Russell small cap. So, yeah, I've got a view on the market. I think it's a little breathless here, and I'd anticipate a break. But I'm also, I'm not betting the ranch on it, that's for sure.
Gold hit all-time highs 3 weeks ago, then dropped about $200 in just a few days, bounced back over 100, then sold off another 100 by early this morning. What's driving these wild swings, and do you think the bull market for gold is still intact?
Well, on that last question, is the bull market still intact? I mean, yes, it is so far. Will it continue? Well, that's open to question, and maybe I'll get into that. We had the gold market fall off, along with a lot of other things when we had the panic hit in early March. And since then, since the lows of March to where we were here 3 weeks ago at the beginning of April, gold jumped $600. That was about a 40% increase from the March lows to the August highs. For the past several months, the buying in the gold market has been very much dominated by American gold ETFs. There's gold ETFs around the world. The United States is by far and away the largest, but you take United States, Canada, and Europe together, then all the other ones don't even matter. But the past few months, it has been absolutely massive buying of gold ETFs in the United States have been the main buying in the market. When I say that, like traditional buying, from retail buying in India and China is down by about half of what it's been the last couple of years. So the issue has been, the market's been driven by this gold ETF buying. And that's retail as well as institutional. Something I've noticed with the gold market is the gold stocks, particularly the major gold stocks, haven't been as exuberant, say, as gold has been. And I think one of the ways I look at that is if you're an institutional account or a typical institutional account, you probably are not going to go out and buy a bar of gold, but you might go out and buy shares of Barrick or Newmont or something like that. So it would seem to me that, the institutional money hasn't come into the gold market to the degree that retail has. I got to mention the COMEX futures market. We had delivery issues in the April period in particular, when the market different markets got out of line one with the other, and the arbitrageurs couldn't physically move gold from one place to another to close the arb. And we've seen the open interest in COMEX really come off and really never came back. Like, if we hadn't had those delivery issues, I think we would have seen open interest in the gold futures up a lot more. We would have seen a lot more participation by retail than what we have seen, and we've seen a lot. So COMEX kind of lost a little bit of its leadership where the gold ETFs picked it up. Gold's clearly been tracking real yields, real interest rate yields. So as you take the price of the bonds, subtract out inflation, and you get the real yields, they're negative. In other words, there is not a penalty for stepping out of cash and buying gold. Like you don't pass up the interest you could earn on cash. Gold's also been tracking the U.S. dollar, and particularly I think lately, the past couple of months, maybe shadow strength there from a weaker U.S. dollar. There has definitely been momentum buying in the gold market, like stocks. I got to say, people love to buy a rising market, and that's how the world works. But I think if the stock market was to turn down, and I'm not talking just a little downtick, but like we had a scare in the stock market, I think we'd see the gold price weaken as well. So I think a lot of the buying in gold has been from people that like to buy things that are rising. Now, in terms of whether gold would be $3,000 or $1,200 a year from now, I simply don't know. That's not the time frame in which I do my trading. And just one final thing in that. I did a short-term pardon me for gabbling here, but the way I trade, my time frame is usually I'm trying to say what do I think is going to happen within the next few days into the next few weeks. That's kind of my sweet spot. And on that basis, I did cover a short position in gold yesterday. I've shorted gold on and off here the past couple of weeks and done well with that. I'm not anti-gold or anything for sure. I've been trading gold for, certainly over 40 years. But it just seemed to me as though the gold market was a little overdone at the upside, and I thought it might weaken. Right now, I'm kind of neutral, just looking to see what the next opportunity is.
We'll have more with Victor Adair right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with Victor Adair. Victor, the U.S. dollar hit a 4-year high in March when people went into panic mode. Since then, it's fallen about 10% to its lowest level in 2 years. What's your fix on the U.S. dollar and how are you trading it?
Well, we had a spike in the U.S. dollar in March, again, with that panic that took the U.S. dollar index price up to a 4-year high. And then, as the panic kind of subsided, the stock market started to rally, the U.S. dollar fell back a bit. And when we got to, I'd say about May, so 2 months later, 3 months later from the March highs, the U.S. dollar was back to about where it had begun the year. Now, May is an important time here in the currency markets. It was in the middle of May that Macron and Merkel kind of put their heads together, and I call it just for shorthand, and developed a Let's Save Europe plan. What they came up with was this idea of a common bond or a liability to everybody in the EU, and they rounded up the other people, I guess, with coercion and pressure, they just got the rest of the members of the EU to support this. And I think people who had been negative of euro, and euro was at about a 4-year low in the March period, people saw this as maybe the beginnings of some kind of a fiscal union in Europe. And that's always been the Achilles heel to Europe becoming, a serious currency, or say a contender with the U.S. dollar for reserve currency status. So since the middle of May, the euro has been rising, and the weakness in the U.S. dollar has been predominantly a euro strength story. Actually, U.S. dollar against a lot of the emerging market currencies, U.S. dollar continued to be strong or rising. Now, what we've seen here since the middle of May is the bullishness in the euro has really expanded. We have the what we call a commitment of traders data from the futures markets are showing us that speculators that are net long the euro have the largest position ever in history. So the market is crowded long euro. I've been trading the euro here the past couple of weeks anyway from the short side. I covered my last short yesterday. Right at the moment, I'm aside the market, looking for an opportunity just like I am in gold.
We'll have more with Victor Adair right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, the Canadian dollar hit a 4-year low below 65 cents during the March panic, but has rallied back to around 76 cents. Is this just the flip side of a weaker U.S. dollar, or is there more to this story?
It definitely is. A good part of it is because the U.S. dollar is weak against the major, what we call, say, the G10 currencies, which are going to take in the European currencies, the commodity dollars, the British pound, that sort of thing, the Japanese yen. So, yeah, the U.S. dollar weakness has been a function there. As we've talked previously on the show, the key components over time that contribute to the value of the Canadian dollar is, one, the relative strength or weakness of the U.S. dollar, two, commodity indices, if they're strong or weak, interest rate differentials, and certainly lately, this what I call risk-on sentiment. Now, as we're talking today, it might become obvious that in some respects, you know, it's all one market. When the market is feeling frisky and willing to take risk like they are in the stock market lately, that seems to spill over to some other markets, and Canada has definitely benefited from that. So Canada is up here as the U.S. dollar is weak, as other currencies are rising against the U.S. dollar. Commodity indices generally have been rising from the hole they got into around the March period of time. Interest rates differentials don't matter because Canada and the U.S. are both at zero, so that's kind of a neutral. But this risk-on sentiment that is got into the market, when in the currency markets, it shows up as U.S. dollar weakness. Where are we at here? I think one of the things that I'm concerned about with Canada, and I have had a bias, okay, that Canada, as it was going above 75 cents, surely I thought that Canada would struggle. Here we are at 76. I've had a bias against the Canadian dollar. Again, you know, it's an offshoot of I've had this bias against the stock market. I've had a bias against the risk-on attitude that has permeated a number of these markets. So here again, I think if the stock market was to roll over, as we go into the fall here, we'd see the Canadian dollar lower. And then there's another factor, and that is we're going to see the federal government, which is on holiday, call it right now, going to come back in the fall, in September. And I think we're going to see a much more leftist kind of agenda from our federal government. And I think maybe the rest of the world might not like that so much, and I think we might see some weakness in the Canadian dollar.
Crude prices were falling before the virus news became serious in late February, but when stocks started to fall hard, crude oil fell even harder, with WTI eventually hitting minus $40 briefly on April 20th. Front month WTI is now around $43, but the price action has been relatively flat the past 6 weeks. What are your thoughts on crude? In really short and sweet, crude is what I call a lack of demand story. I think crude has been struggling here, as you say, the last 6 weeks or so. Prices have kind of inched higher, but it's been pretty flat looking compared to, say, the chart of the NASDAQ or anything else like that. And maybe it's also a case of, it never rains but it pours. We've had Exxon, the venerable energy company, has been kicked out of the Dow Jones.
The energy component of the S&P index right now is about 3%. That's a 30-year low. Energy is maybe the forgotten market right here, right now. And certainly you look at some of the Canadian or international share prices of energy companies, that they are in the doghouse. So this lack of demand, and I wonder sometimes if maybe the crude oil market isn't giving us a much better picture about the true strength of global economies than, say, the stock markets are. But, I'm not about to put a spread on where I buy crude and sell the stock market, although that's interesting. We're going to have that Hurricane Laura make landfall tonight, I guess, along the Louisiana, Texas coast. So the Gulf is virtually shut down, both for production and refining right now. So that's a short-term function here with crude. I've got positions on that are generally bearish on crude, and this is calendar spreads. As you know, in the futures market, we got these delivery dates at different points out in the future. I am basically short nearby crude, long the more deferred contracts, looking for the shape of the contango, the forward curve to steepen, and that's basically a bearish view. The crude oil market is usually a big component of the commodity indices that we have. And going back into March, we had the commodity indices, like a lot of other things, really hit some lows, but bounced back to about where they were before we saw the decline begin in February. Some commodities, like lumber, certainly have gone ballistic since we saw those lows in March. But the commodity indices generally here have not been as hot, say, as the stock markets, and particularly with crude as relatively weak as it's been, I think maybe giving us a better feel for just how strong the economy is. A much better feel than, I think, how the financial markets are showing.
The hugely important presidential election in the U.S. is just over 2 months away. There's rioting in the streets. The COVID virus seems to be spreading. People do hope a vaccine may be just around the corner. More than 30 million Americans have lost their jobs in the past few months, but the median home price has gone up. The stock market is booming. There seems to be a huge divergence between what the U.S. economy is doing and what the stock market is doing. When you're trading, how do you know what to do given that there's these two giant gaps?
Well, there's always uncertainty. And, you got to start with, I think, you're going to have a bias. Whether you know it or not, you're going to have a bias. I think, rather than pretending you don't have one, own up to the fact that you've got a bias and deal with it. And as I just said earlier about the Canadian dollar, for instance, or the stock market, I was biased to think that the rallies had gone too far, so I started shorting them and lost money. Now, I didn't lose a lot of money because I just have learned over the years that I'm wrong a lot. And the old adage is nothing wrong with being wrong except staying wrong. So, keep the losses small, go back to the sidelines, and then go from there. Make sure you preserve not only your mental capital, but also your physical capital. I just on that subject, I was talking about it's all one market with this risk on or risk off, and lately it's certainly been risk on. So there's these correlations across markets, and sometimes you might think that you've got diversification. You got positions in currencies, positions in commodities, positions in the stock market, and therefore you've got diversification. But actually, those trades could all be highly correlated. One of the things that you have to remember is the only thing you can trade is price. So whether or not you think the price is where it should be, or you think it's goofy and you want to fade it or whatever. That's all you have to trade. But, and there's always this rub here, what is it that you think you're trading? And I know my son Drew and I talked this over a lot, and in particular, the copper market, for instance. I'm saying, when you're trading copper, are you trading like, red metal bars that are stacked up in a warehouse somewhere? Are you trading some sort of a Chinese hypothecated financial instrument? I don't mean that to sound weird, but it's just sometimes when you're trading something because of your bias, you think you know what you're trading, and if the market happens to go your way, then you think, see, I knew what I was doing there, but in fact there was something else entirely that was moving the market that you had no idea what it was. So clearly, you never know what's going to happen. You try to make probability bets. You have to focus on what is your time frame and stick to that. What is your sizing? How are you going to do your sizing? I mean, I am much more conservative in my sizing than when I was, say, 30, 40 years ago, much less aggressive. And just to acknowledge that it's not a game of perfect. You're going to win some, you're going to lose some, and you're going to actually lose a lot. So, get used to that. I'd say people that say that have jumped on, and it would seem there's a lot of new folks in the market that have jumped on the rally in the stock market and have done very well, must think, boy, this is easy. Well, I'm happy for them, honestly, but at the same time, you run the risk of overstaying your welcome, or thinking that it's too easy. And I asked the question, what are you going to do when it's wrong? So you have to have all these things in mind. You grind away, you develop a method to trade or a process that suits who you are, and that'll probably have to change over time as markets change and as you change. But you can't just read a book or somebody says, here's my 16 rules for trading, and if you do this, this, and this, you're guaranteed to make money. It just doesn't happen. The world keeps changing, and you got to change along with it.
Now, Victor, I want to pick your historic brain here. Hurricane Laura has been upgraded to a Category 4. That makes it as bad as Katrina and Ike and some of those other very devastating storms. 84% of the Gulf refineries have closed down because of it, and it probably will end up being 100% or close to it. What does that do to oil prices for consumers even in Canada?
You'd think that would mean oil prices would jump. And as I'm looking at the board right now, we're trading just about exactly where we were yesterday. Gasoline and heating oil prices are both below where we closed yesterday. So obviously yesterday, people that are really pros in this business of trading crude and the derivatives would have figured out what was going to happen with the storm coming aboard, or the hurricane, I should say, that's more appropriate, and they've taken their positions accordingly. And maybe it also says to you, gee, given that what should be kind of a bullish event, shutting down production, shutting down refining capacity, isn't kicking the price up, maybe this tells us that there is an underlying issue in the market here where there is not enough demand to soak up all the supply that's out there. We're just talking in purely economic terms here. The hurricane, some people are going to get killed in this thing. It would seem likely. It must be a devastating experience to live through a hurricane, to see businesses and homes and all that smashed up by a hurricane. And I don't mean to make light of that at all, but we're just talking about the economics of it.
Victor, thank you so much for chatting with us.
Jimmy, it's always fun to talk with you. Thank you kindly.
My guest has been Victor Adair, co-founder of the Polar Futures Group. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.